Hello, and thank you for attending our presentation today, a CPA's 2025 Guide to Household Employment Compliance. My name is Trevor Sparks with GTM Payroll Services, and we appreciate the time you're able to spend with us today. A couple of housekeeping notes before we get started. If you have any questions, please use the questions functionality in the presentation console to submit them. We'll answer as many questions as we can during the presentation. If we don't get to your question, we'll follow up with you within the next day. And you'll receive an email after the presentation with a link to download the slides, as well as a video recording. During today's presentation, we'll ask you 4 questions. You must answer at least 3 questions to receive CPE credit. As a reminder, this course is 1 CPE credit hour. If you successfully complete the course, we'll email you this certificate of completion within 5 business days. Here's an overview of what we'll go over today. We'll discuss the basics of when someone is the employer, what happens as an employer, what obligations the employee has, what risks the employer has, what insurance is required, what's been happening with household employment and what's new this year, including paid leave laws, rising minimum wage rates, and labor compliance regulations. And also how to convey the importance of compliance to your client when saying it's the law isn't enough. At the end of this presentation, you'll understand your client's household employment tax responsibilities and how to manage them, new labor laws that are impacting household employment, what's new this year in household employment tax compliance, and how to explain the benefits of compliance to your clients, as well as the costly downside if they're caught not following the law. So at this point, I'd like to turn it over to our presenter today, Mike Trucolo. Mike?
Thanks, Trevor. So before we get into what's new, I just want to take a step back and look at the basics of household employment itself, starting with who is a household employer and who the domestic employees. For the most part, it is a family hiring a nanny to look after their children in the family's home. But we're also seeing more and more senior caregivers hired to help elderly loved ones age in place, as well as many nanny shares, where one nanny cares for the children of multiple families in one of the family's homes. They've grown in popularity as an alternative to daycare centers. We've come a long way since 1993, when President Clinton's nominee for Attorney General, Zoe Baird, was removed from consideration for the job because she and her husband broke the law by employing 2 illegal aliens to nanny and chauffeur their child and failed to pay employment taxes. That prompted Congress to change the way household employment taxes are filed and to create the Schedule H, which shifted nanny taxes onto Form 1040. So we typically think of a household employee as a nanny, but anyone who works in someone else's home could be considered an employee. So as we mentioned, senior care is a growing workforce. If your client privately hires a senior caregiver, either for themselves or an elderly loved one like a parent, instead of going through a home health care agency, that worker would be considered an employee of the senior or the family. Another area you may not think of is seasonal or temporary childcare. A babysitter with regular hours, a nanny hired just for the summer, or an after school nanny can easily earn enough for household employment taxes to kick in. Other household employees may include personal assistants, housekeepers, chefs, chauffeurs, or any other estate staff and nanny shares. When a family hires a nanny, it's straightforward who the employer is. But I just want to point out that there are a couple of additional wrinkles when hiring senior care. So your clients have a few options for finding senior care, and how they bring the in-home caregiver on board will determine whether they are now the employers. So a home healthcare agency will employ the caregiver to work in the senior's home, they'll pay the employee, file taxes, and comply with the tax, wage, and labor laws. In this case, the agency controls the job duties of the employee. The agency will select the caregiver and send them to the senior's home. However, the senior may not always get the same caregiver. The agency is the caregiver's employer, so they control the employment. A referral or a placement agency recruits senior care work on behalf of the family. They charge a fee for this service and then hand over control of employment to the family, which is then responsible for payroll, taxes, insurance, and compliance. The caregiver is an employee of the senior or the family, and this is similar to a family hiring a nanny through a nanny agency. So by doing it themselves, a family finds, recruits, and hires the senior care worker without the assistance of an agency. The family will also handle payroll, taxes, insurance, and compliance. So in this scenario, the caregiver is an employee of the senior or of their family. So a lot of families will try to avoid household employment taxes by classifying their worker as an independent contractor. That way they can give them a 1099 at the end of the year, and the employee is then has to pay the entire tax obligation. An independent contractor pays both the employer and employee FICA tax obligation, which is 15.3% of cash wages, and the family avoids unemployment taxes and other responsibilities, such as workers' compensation insurance as well. However, the IRS almost always classifies household workers as employees and not independent contractors. So that's not going to work, and here's why. It comes down to a matter of control. So a family sets their employee schedule, they tell their employee how to do their job, and the employee uses the family's tools and equipment. So for example, a family with a nanny says your work hours are Monday to Friday, 8 a.m. to 6 p.m. The baby takes a nap at this time and is fed at these times. The nanny uses the family stroller for walks and their kitchen to prepare food. A nanny is not going to determine when they'll work, and they're not going to make up a baby's sleeping schedule and eating schedule. So in this scenario, the family is in control of the employment and the nanny is their employee. And if there's ever any doubt, you can always file Form SS8 with the IRS and have the IRS decide on the worker's status. Just understand that employee misclassification is considered felony tax evasion. At this point, Trevor, I will turn it to you for our first poll question.
All right, thanks very much, Mike. All right, the first poll question is launched. Should be on everyone's screen. You can answer A, B, C, or D. Just answer right there on your screen. Which of the following affects whether a domestic worker is classified as an employee or an independent contractor? So this is the first of our 4 poll questions today. You'll need to answer 3 of the 4. You don't have to answer correctly. You just need to answer them, and then you'll uh, and then you'll be eligible for that CPE credit. And those certificates will be sent out in the next couple of days or so if you qualify for that. If you have any questions as we're going through the material, feel free to put those in the questions module in the webinar console. We'll get to as many questions as we can at the end of the presentation. If we don't get to your question, we'll be sure to follow up with you. Looks like we have everybody in, and the answer here is D. All of the above will affect whether a domestic worker is classified as an employee or independent contractor. Okay, Mike, I'm turning it back to you.
All right. So one of the first steps to understanding nanny taxes is determining whether the employee's wages have met or exceeded the employment coverage threshold for domestic workers. This is commonly called the nanny tax threshold. There is no coverage threshold for most industries, so every dollar of wages is covered and taxable. Household employment is one of the industries with an employment coverage threshold. The Social Security Administration sets this amount each year, and for household employees, it changes with the National Average Wage Index. The threshold for wages earned this year is $2,800. Last year's threshold was $2,700. Use the 2024 threshold if you're filing a client's tax return for the October 15th extension deadline. So you can see how easy it is, even for a temporary or seasonal worker, such as a summer or after-school nanny, to exceed that threshold and trigger nanny tax compliance. If the family goes over that wage threshold, they'll need to withhold and pay Social Security and Medicare taxes, which are commonly known as FICA taxes. That total is 15.3% of cash wages, which is split evenly between the employer and employee, with each of them contributing 7.65%. Employers can choose to pay their employees' share and not withhold it. Keep in mind that the taxes paid to cover an employee's share of FICA must be included in their wages for income tax purposes. These aren't counted as Social Security and Medicare wages or as federal unemployment wages. You can report the Social Security and Medicare taxes paid in boxes 4 and 6 of the employee's W-2 form and add the taxes to the employee's wages reported in box 1 of the W-2. Remember not to include wages paid to a spouse, a child under the age of 21, a parent, or any employee under the age of 18. For unemployment taxes, if cash wages to an employee is $1,000 or more in any calendar quarter, then the employer pays federal unemployment tax, and that's 6% of cash wages on the first $7,000 of those wages. An employer may also owe state unemployment taxes. They may be able to take a credit against their federal unemployment tax if they pay state unemployment. It could be as much as 5.4%, which would really reduce the amount owed for federal unemployment. For unemployment taxes, the exclusions are spouses, children under the age of 21, or parents. So, just to review a couple of key points, household employment tax responsibilities kick in at the $2,800 threshold for any cash wages in 2025 or $2,700 for 2024. The family pays 7.65% of their employees' pay in FICA taxes, and they also pay federal and state unemployment taxes if applicable. For the employee, they also owe 7.65% of their pay, and this is required to be withheld and remitted by the family. And again, the family can choose to pay this on their employee's behalf instead, but either way, the employer is responsible for remitting the employee's portion of the FICA taxes. Federal income tax does not need to be withheld, only if the family wants to. However, it's always a good idea to withhold so that the employee is not stuck with their entire income tax bill at the end of the year. If a family decides to withhold income tax, they need to provide their employee with a Form W-4 and a state withholding form. This is going to determine how much to withhold from the employee's pay for income taxes. So state and local taxes, if applicable, will obviously vary depending on where the employee lives. So we know what is owed, but how are these taxes remitted? So you have two ways that you can do this. The first way is probably the best way to do it. Remit household employment taxes quarterly using Form 1040-ES, then detail the annual amounts paid on the Schedule H. If your client prefers, they could increase withholdings from their own pay to anticipate this increase to cover their household employment taxes. You should do one or the other. If their nanny tax obligation is large enough, your client may wind up owing taxes when they file and possibly be subjected to an estimated tax penalty and interest for underpaying taxes during the year. And Trevor, I will turn it over to you for our second poll question.
Okay, thanks very much, Mike. Our next poll question is on everyone's screen. An employer can choose to pay the employee Social Security and Medicare tax responsibility, 7.65% of gross pay. Answer right there on your screen. This is the second of 4 poll questions today. If you have any questions on the material we're presenting, please put those in the questions box in the webinar console, and we'll get to questions at the end. If we don't get to your questions, we'll be sure to follow up with you. Also, we'll have a brief survey that will pop up as the webinar ends. So if you can just take a quick moment and answer 5 multiple choice questions, that would be helpful for us. Looks like we have, I'm just waiting for a couple more people to come in. And again, at the end of the day, you'll receive an email that'll have a link to download this presentation as a PDF as well as a video recording that you can view. Okay, looks like we have everybody in here. The answer is true. An employer can pay their employees FICA taxes. All right, we'll continue on. Turning it back to you, Mike.
Thanks, Trevor. All right, so let's talk paperwork. So here are some of the forms needed as a household employer. So the SS4 will be needed to apply for an EIN, which can also be done online as well. The family will also need to be set up as an employer with their state and file a new hire report. And they'll also need to obtain a Form I-9 from their employee, which we'll get into more in a moment. If they're deciding to withhold income taxes from the employee, they'll need to obtain Form W-4 and a state withholding form from their employees. So a little bit more about the I-9 form. So families with household help must collect the I-9 from their workers at the start of their employment. This is a form that we've all filled out when starting a new job, and it's no different for nannies, housekeepers, and senior caregivers. As a reminder, the I-9 confirms a worker's identity and authorization to work in the U.S. They can either submit a document from List A to prove their identity and employment authorization, or documents from List B and C. The I-9 must be signed no later than the first day of employment, and the documents must be presented within 3 business days from the start of employment. The family needs to inspect the documents, make copies, and return the originals to their employee. The documents must reasonably appear to be genuine and relate to the employee. Copies of these documents are kept in the employee's personnel file with their I-9 form, and they are not returned to any government agency. Employers must retain the I-9 form for either 3 years after the date of hire or for 1 year after employment is terminated, whichever date is later. The I-9 form can be completed electronically to help reduce errors as well, and it's available on the U.S. Citizenship and Immigration Services website at uscis.gov. At year end, the employee needs to receive their W-2 by January 31st. Also, Form W-3 and Copy A of Form W-2 must be submitted to the Social Security Administration by the same date, and the Schedule H is later filed with the employer's personal tax return. So what we've covered so far is basic tax withholding responsibilities, and now we'll get into some of the labor, tax, and payroll nuances surrounding household employment. Some of these are state specific, such as a domestic workers' bill of rights. There are also rules around overtime pay, live-in workers, sleep time, and companionship care. And in a growing trend, many states and cities have paid leave requirements that are now impacting household employers. So, what is a domestic workers' bill of rights? So, these laws bundle domestic worker protections, which could include minimum wage, overtime pay, paid time off, days of rest, among other things. In New York, for example, household employers must give 1 day of rest for every 7 days and provide written policies on sick leave, vacation, and work hours. 3 paid days off after a year of work, and they must pay on a weekly basis, and they'll need to provide pay stubs even if the employee is paid electronically or by direct deposit. Massachusetts is similar. There are protections for a mandated amount of rest time depending on the hours worked, written work agreements, and more. If you have clients with household employees in any of the states or cities with domestic worker protections, you'll want to familiarize yourself with those obligations. The first Domestic Workers' Bill of Rights took effect in New York in 2010. Since then, several other states and the cities of Chicago, Philly, Seattle, and Washington, D.C. have enacted similar laws to grant basic labor protections to household employees. As a heads up, domestic worker protection legislation is working its way through the state legislature in Washington. It passed the state Senate and is with the House for consideration, so we're actively keeping an eye on that one. You'll hear us say this frequently during the presentation, but noncompliance is very costly. So here's just one example from New York. If your client violates the state's Domestic Workers' Bill of Rights, which requires weekly pay for household employees, they could be sued for up to 300% of those delayed wages, plus attorney fees and interest. So again, it's important to review the domestic worker protections in your state and city. The FLSA, which is the Fair Labor Standards Act, includes household employees. Domestic workers must be paid at least the applicable minimum wage rate. The federal minimum wage is $7.25 an hour, and that hasn't changed for quite some time. However, many states, counties, and cities have enacted higher minimum wage rates than the federal rate. In California, for example, the minimum wage is $16.50 an hour, which supersedes the federal rate and becomes the applicable rate. However, dozens of cities in California have higher rates than the state rate. Los Angeles is now at $17.28 an hour, San Francisco is $18.67 an hour, so those local rates would apply. On July 1st, Los Angeles increases its minimum wage rate to $17.87, and San Francisco moves to $19.18. Just to make it even trickier, many states have built-in increases to their minimum wage rates. So you'll need to pay attention to this if your client is paying their employee minimum wage or close to it, as that hourly rate may quickly violate wage laws. So according to the FLSA, household employees are non-exempt workers. That means they must be paid hourly rather than a fixed salary. And this also means household employees get time and a half in overtime for hours worked over 40 in a 7-day work week. Live-in employees and caregivers who meet the companionship care definition may be exempt from overtime. We'll get into those situations in a moment. California is a little bit different. Time and a half kicks in after 8 hours a day, 40 hours a week, and the first 8 hours worked on the 7th consecutive day of work in that week. Your clients with household help should maintain records of hours worked and pay to ensure that they're meeting minimum wage and overtime rules. This is where many household employers get into trouble. They'll forget to track hours or pay and wind up getting sued by disgruntled employees who seek back wages as they weren't paid properly. So, live-in employees. You'll see this with nannies or seniors who need around-the-clock care. Up to 8 hours of sleep time can be unpaid if certain criteria are met, and 5 hours of continuous sleep is a big one. If a live-in nanny is expected to be on call during the night and their sleep time is interrupted to care for a child, even if it's just for a few minutes, and they don't get at least their 5 hours of uninterrupted sleep, then the entire 8 hours of sleep time is now paid. The exception is California, which doesn't allow sleep time to be unpaid. As for overtime, federal law exempts live-in employees from overtime pay. However, some states like New York have their own overtime requirements for live-in employees, and those will supersede federal law. In Minnesota, overtime for live-in employees starts at 48 hours, and Oregon, like New York, is 44 hours. In Hawaii and Maryland, live-in employees need to be paid overtime for hours over 40, so they're not excluded from OT laws in those states. Companionship care. This is a key consideration in senior care. If a caregiver falls into the companionship care exemption, they do not need to be paid overtime for hours worked over 40 in a work week. If they don't have the exemption, then they must be paid overtime. So work is defined as things necessary to care for an elderly patient. So that'll be things like bathing, dressing, cleaning, and cooking. Only 20% of a caregiver's work time can be spent doing these sorts of activities in order to qualify for the exemption. That means the rest of their time is spent with fellowship and protection. So that can be things like watching TV, doing puzzles, playing cards, or doing whatever it is that is not necessary to take care of the elderly patient. It's also important to know that the exemption doesn't apply to caregivers that are hired through a third party. So if a family thinks they can take advantage of the companionship care exemption, hiring privately and not going through a third party could be a big financial benefit. There is a growing trend for paid family and medical leave at the state level, and many of these programs include household employers. There are more than a dozen states now with laws requiring paid leave, and we've listed several of them above here. So California, Colorado, Connecticut, Illinois, Massachusetts, Michigan, Minnesota, New Jersey, New York, Oregon, and Washington State are all active, meaning household employees, if eligible, can take leave for qualified reasons. A couple to keep in mind if you have clients in these states: contributions to Maryland Family and Medical Leave have been delayed once again. Payroll deductions for those will now start in January 2027, with benefits being available the following year. In Minnesota, contributions to its paid and family leave program start in January of 2026. And in Missouri, while voters approved a proposition for paid sick leave in November and the requirement went into effect on May 1st, a bill repealing these paid sick leave provisions is with the governor, who is expected to sign it into law. However, the repeal will not become effective until August 28th. Localities like New York City, Chicago, and Washington, D.C. all have paid leave requirements as well. Paid leave laws often include all employers, even those with just one employee, such as a family with a senior caregiver or a nanny. These programs may require a small employee contribution through a payroll deduction, or your client can cover that contribution for their employee. So it's important to look at any paid leave laws in your state and determine if it applies to household employers. If they do, you'll need to follow the rules around contributions if they're required. So we mentioned earlier that families may try to classify their employees as independent contractors in order to avoid their tax obligations. Another way to avoid their responsibilities is to put a nanny or a senior caregiver on company payroll, which would not fly with the IRS either. It's considered an illegal tax deduction because all employees on a business's payroll must directly contribute to the business's success. So, of course, there is an exception. A sole proprietor of a business or farm with household employees can report their household payroll taxes on their company's Form 941 or Form 943 for farmers for ease of filing. That doesn't mean they can put their household worker on their business payroll, but it just means that they can report the taxes on Form 941 or 943. Even with this exception, and to keep it simple, it may be best to keep household payroll taxes separate from the business related taxes. File Schedule H for household and Form 941 for business, or Form 943 if the business is a farm. Outside of that one exception, do not use Form 941. Using the 941 and not a Schedule H is a very common way accountants may handle household payroll and make mistakes when reporting the employment taxes. This misstep can make more work for you, increase the risk of penalties, cause dual reporting to the IRS, and create other accounting issues as well. The Schedule H was created specifically for household employers to report the wages paid to their employees during the year. It's an annual filing that's prepared with their personal income tax return. Form 941, however, is filed every quarter, even if your client didn't pay an employee during that period. If you fail to file the 941, even with no payroll to report, your client will incur penalties. So, record keeping and reporting. You should keep copies of the Schedule H and other employment tax forms filed as well as Forms W-2, W-3, and W-4. For unemployment tax purposes, you should always retain the total amount of employee compensation, amount subject to unemployment tax, and state unemployment contributions. Keep payroll and tax records separate for at least 4 years after the due date of the return on which you report the taxes or the date that the taxes were paid, whichever one is later. Unemployment tax records should also be retained for 4 years after their due date or the date the unemployment tax was paid, again, whichever one is later. Most states have a 2-year statute of limitations on lawsuits filed by former employees, so be sure to keep documentation for at least that time period. And for auditing purposes, you may want to maintain tax and payroll records for up to 7 years. In any case, it's always a good idea to maintain employee, tax, and payroll records for longer than you think you'll need them. So those are just the basics when it comes to tax, wage, and labor laws for household employment. I also want to highlight liability insurance, as this can be one of the costliest mistakes that a household employer can make, and a very easy way for a family to get caught if they're not paying their employee on the books. So you never know when an injury might occur, whether it's around the house, driving the kids in the car, or walking the dog. Unforeseen risks are always in play. Household employers in many states are required to carry workers' compensation insurance for employees who get hurt or get sick on the job. Workers' compensation will help pay for medical expenses and lost wages. And without that required coverage, a family could face thousands of dollars in fines and penalties and a possible lawsuit in order to recoup lost wages and pay for medical expenses. So even if workers' comp is not required, it may be wise just to get voluntary coverage. So who does benefit from workers' compensation? So both the employee and the employer are protected by this. Some of the employee's medical bills and lost wages will be covered, and the employers are very likely to avoid a lawsuit. So this kind of protection can easily be worth tens of thousands of dollars for your high net worth clients. So a popular question we get at GTM when the topic of workers' compensation comes up is, doesn't my homeowner's insurance cover this? So the short answer to this is no. There's a difference between someone visiting your home, slipping and falling, or even a worker like a plumber or an electrician getting injured while working in your home versus having somebody employed in your home for 20, 30, 40, or even 50 hours a week. Never assume that an employee is covered under homeowners insurance. The exceptions to these are New Jersey and California. So in New Jersey, you can add a rider for your workers' compensation to your homeowner's policy, which is substantially cheaper than a standalone policy. And in California, it's actually required to have workers' compensation on your homeowner's policy if you have a household employee. So this is what we mean by not having the required workers' comp can become one of the costliest mistakes for a household employer. Fines can be as high as $5,000 for every 10 days of noncompliance, which is about $15,000 a month. It's not uncommon for fines to quickly reach tens of thousands of dollars. The GTM Insurance Agency, which is an affiliate of GTM Payroll, will receive calls when a family is looking to get coverage because they just got caught not having a policy or their employee got hurt. Once, a family came to us after getting a $120,000 fine for not having the required coverage in place. So again, looking at the workers' comp rules in your state is important. So we've listed the states here where it's required for full-time, part-time, and full-time only workers. So how does somebody get caught? So this scenario happened in Connecticut to a family that was paying their nanny off the books. So their nanny fell down the stairs while carrying a baby, and the baby was okay, but the nanny had injured her back. The nanny went to the hospital, and the doctor asked, how did this happen? The nanny responds, well, I was working. So it becomes a workers' compensation case, even unintentionally. The nanny had missed several weeks of work, and she expected all of her medical bills to be paid and to receive her typical pay while she recovered. The family didn't want to pay because they were already paying another caregiver to cover for their injured nanny. So a couple of things happened here. The family was exposed for paying their nanny illegally. And why? Because they didn't have the workers' compensation insurance in place. They dealt with back taxes owed, plus fines and penalties on those back taxes, and they dealt with fines for not having workers' comp insurance, which in Connecticut is $300 a day for every day that the coverage is not in place. So you can see how that adds up very quickly. On top of that, the family was required to pay the employee's medical bills, lost wages, and a fill-in nanny, and needed to find another employee afterwards as they had already damaged the relationship with their original nanny. So on that note, I will turn it over to Trevor for our third poll question.
Okay, thanks very much, Mike. Our third poll question should be on everybody's screen. The question here, workers' compensation insurance protects employers from which of the following risks? So just answer right there on your screen, A, B, C, or D. Excuse me, this is our third of four poll questions. You'll need to answer three of the questions in order to receive CPE credit. Those certificates will be emailed to you in the next few days. At the end of the presentation, we'll get to your questions. So if you have any on the material we've been presenting, please submit those in the question box in the webinar console, and we'll get to as many questions as we can today. If we don't get to your questions, we'll be sure to follow up with you in the next day or so and get you those answers. Also, at the end of our presentation, you'll have a survey to complete, 5 quick questions. We appreciate the feedback if you can provide that for us. Also today, you'll receive an email with a link to download this presentation as a PDF and a link to a video recording as well. So you'll have that in your toolbox. All right, looks like we have everybody in on this question, and the answer here is D. Both A and C are correct. All right, turning it back to you, Mike.
Thanks, Trevor. Okay, so let's look at some updates in the household employment industry. The tax reporting rule for mobile payments is now being phased in. Employees would have received 1099-K forms this past tax season if last year's reporting criteria of $5,000 in transactions was met. The threshold will be lowered to $2,500 this year before reaching the statutory level in 2026. The reporting rule may change how your clients pay their nannies and babysitters. Payments for goods and services such as babysitting or childcare through third-party settlement organizations such as Venmo, PayPal, and Cash App were reported to the IRS if those transactions totaled $5,000 or more. The intent of this requirement is aimed at businesses that use these apps to get around banks and traditional forms of reporting income. The IRS wants to make more transactions reportable, so it's harder for businesses to underreport their taxable income. Unfortunately, the household employees are getting swept up in all of this as well. Families that employ full or part-time household help, such as nannies, in-home senior caregivers, and housekeepers, may want to avoid using mobile payment platforms to pay their workers, as those workers will likely get a 1099-K from the IRS as well as a W-2 from their family, which can cause some confusion when filing tax returns. Paying a date night or an occasional babysitter through a mobile app is still acceptable, but those sitters should know that this income will likely be reported to the IRS and should be reported on their personal tax return. It's always been a requirement to report income when net earnings from self-employment exceed $400. This new rule just broadens the reporting of tax information to the IRS. So remember, it's not a new tax, it's just a new reporting requirement. A seemingly easy way to circumvent the new rules may be to pay for a babysitter's services in a personal transaction as if they were a family member or a friend. However, if you pay a babysitter on a regular basis, those consistent transactions will raise red flags with the payment platform and call into question whether those payments were truly made to a family member or a friend. In fact, PayPal, which also owns Venmo, says it will monitor accounts to ensure that personal payments are not being used for the sales of goods and services. It is always best to pay a babysitter as a service transaction. A best practice would be to pay a full-time nanny or employee by direct deposit or by check. So here are the contribution limits for certain employee benefits for the 2025 tax year. Contributions are made on a pre-tax basis, which can reduce the amount your client and their employee owe in taxes. Plus, offering benefits is a great way for your client to retain top workers and attract the best candidates. So here are some of the key contribution limits relevant to household employment. So I just want to start by highlighting the QSEHRA, which stands for the Qualified Small Employer Health Reimbursement Account. This can help an employee reduce their healthcare costs tax-free. This is for employers with less than 50 employees as long as they don't already offer a group health insurance plan. So perfect for families with household help. Employees are reimbursed for health insurance coverage purchased on the individual market or through the healthcare exchange, and for out-of-pocket medical, dental, and vision expenses. These QSERAs are funded by the employer, and these contributions are not taxed for the employer or the employee. Reimbursements are also not taxed as long as the employee has a health plan that meets minimal essential coverage. As we've discussed, household employees are required to be paid the highest applicable minimum wage of the federal, state, and local rates. State and local rates have been on the rise. Many states and cities are making annual incremental increases until they hit $15 an hour. So this is just a sampling of states and other jurisdictions that are popular for household employment and will increase their minimum wage rates on July 1st. This is not exhaustive, but it just gives you an idea. Clients paying minimum wage or close to it will need to keep an eye on these rate increases as their employees' pay may quickly become a wage violation. Some new paid leave programs have requirements to be aware of. So in Maine, benefits for household employees are now available under that state's paid family and medical leave program. In Minnesota, the first quarterly wage detail reports are due on October 31st. These reports must detail the wages paid to employees between July 1st and September 30th of this year. You'll submit this information using the existing state unemployment insurance system. The quarterly wage detail reports submitted for paid leave are identical to the wage detail reports employers currently submit for unemployment insurance purposes. And then, on January 1st, employers can begin deducting the employee share of paid leave. As mentioned earlier, Maryland has delayed the implementation of its family and medical leave insurance program. Payroll deductions won't begin until January of 2027, with benefits for employees starting a year after that. In Michigan, accruals for its Earned Sick Time Act started in February, and employees can now receive up to 40 hours of paid sick time a year. I'd like to wrap up with some of the benefits of being compliant now. We've already talked about the first three benefits on this list. It's lowering your risk and avoiding trouble with the IRS, workers' compensation boards, and disgruntled employees. A client can also take advantage of those tax breaks, which may be more than their nanny tax obligation. For an employee, they'll have a legal employment record and verifiable income, which can in turn help with getting a loan, a mortgage, or a line of credit. If a nanny wants to buy a home or a car, it's better that they're paid legally. They can also get unemployment benefits if they are let go through no fault of their own. They're also protected by workers' compensation if they're injured on the job, and in states with disability insurance requirements, they're protected for injuries outside of work. With senior care, you can look to reduce costs through long-term care insurance and veterans benefits. To take advantage, you may need to provide payroll information and caregiver activity logs, so the caregiver will need to be paid legally. Your client may be able to deduct expenses they paid during the year for medical and dental care for themselves and their spouses, as well as their dependents. IRS Publication 502 has more details on this. With a medical care or healthcare FSA that's offered through your client's employer, they may be able to pay their elderly loved one's medical expenses that aren't covered by insurance. The senior must qualify as their dependent for this. If the person receiving care lives with your client, is physically and mentally unable to care for themselves, and requires a caregiver to care for them so that your client can work, then your client may be able to pay some of their senior's care expenses with that dependent care FSA offered through their employer. The senior may also be a qualifying individual under the Child and Dependent Care Tax Credit. The senior must be physically or mentally incapable of self-care, have lived with your client for more than half the year, and be their dependent, or you could have been their dependent, under certain exceptions. So these are potential options for your client to reduce their tax obligation and reduce their costs as a household employer. Trevor, I will turn it to you for our last poll question.
Okay, thanks, Mike. The final poll question should be up for everyone. What are the benefits of being compliant with domestic payroll laws and regulations? Again, just answer right there on your screen, A, B, C, or D. As Mike mentioned, this is our final question of our presentation, as we just have just a couple more moments of our formal presentation before we get to your questions. So if you do have questions, now is the time to pop those into the question box in the webinar console, and we'll try to get to many of those as we can today. If not, we'll follow up with you within the next day or so. Also today, you'll receive an email with a link to download this presentation as a PDF and a link to a video recording. You'll also see a survey come up as you leave the webinar, so we'd appreciate just a quick moment to answer a couple of questions for us. The feedback really helps us, so we would appreciate that. And let's see. Yeah, looks like we got everybody in. The answer here is D. All of the above are the benefits of being compliant. And Mike, I'll turn it back to you.
Thanks, Trevor. So, don't procrastinate. We can't emphasize this one enough. Household employment compliance is not something that you want to handle at tax time. You have enough going on, and you don't need a client to tell you in January that they hired a nanny the previous year but haven't been withholding taxes. You'll then have to track down hours and wage information to make sure that minimum wage and overtime rules have been followed. And that's the last thing that you'll want to do during your busy time of year. So it's much better to get on top of this at the time of hire. Also, just keep in mind, workers' compensation needs to be in place before the employee starts working. And again, those fines are daily for not having the coverage in place, so it's important to get them set up beforehand. So here's a list of resources available, including publication 926, which is essentially the IRS Bible regarding household employment. We've discussed using Form SS8 if you want the IRS to tell your client that their nanny is an employee and not an independent contractor. Form W4 is needed if your client will withhold income taxes from their employee's pay. So I'd like to thank everyone for attending our presentation today, and I do hope that you found it valuable. We do have some time for a few questions now. If anything comes up while you're handling nanny taxes or household payroll, please don't hesitate to contact us. We are more than happy to help out. So on to the questions, Trevor. What do we have?
Okay, Mike, the first question we have, this actually came in through the sign-up process, so we'll get to this one. If a person is working as an au pair and is not a U.S. citizen, does payroll need to be set up and taxes withheld?
So au pairs can get a little bit tricky. Some of what applies to household employees will apply to those au pairs. So au pairs on a J1 visa are generally considered non-residents for tax purposes. The stipend that's given to the au pair by their host family is considered wages, and the au pair is required to file an individual income tax return. The wages for those should be included in their gross income, but their wages are not going to be subjected to Social Security or Medicare taxes. So, since an au pair doesn't need a W 2, and since they're only required to pay the federal income taxes, no withholdings have to be made at all. And the employer doesn't have to file a Schedule H with that. At the state level, though, requirements can vary. So, for example, in Massachusetts, au pairs are considered household employees and they have to be paid minimum wage and overtime. Those au pairs also get paid leave under the state's paid leave law and labor protection, which comes from the Domestic Workers Bill of Rights. So the host family is also required in this case to get workers' comp on those. However, in New York, au pairs, they're also considered household employees for workers' compensation, so coverage would be required there as well. We recommend getting workers' comp when you have an au pair in your client's home, regardless of what the state requirement is. It's always a good protection just in case of any kind of on the job injury. There is a chance that the au pair can be considered a resident if they had previously been in the US as a student, a teacher, a trainee, or a researcher, either in the F, J, M, or Q, non immigrant status. So, if that's the case, the au pair is essentially a household employee, and the host family does need to apply for an EIN and follow those rules as an employer. So, that would be a good question to ask of your client and their au pair.
All right, thanks very much, Mike, for that. Our next question, what about a part-time employee like a nanny hired for summer childcare?
So yeah, this is a really good question as this is now the time of year when the parents are planning for the summer care for their children. So a lot of parents will hire temporary nannies, and for those, the same rules do apply. Once a nanny, even if it's temporary, hits that $2,800 threshold for wages, nanny taxes kick in regardless of how short term the employment is. So that threshold, it can be hit pretty easily. Let's say they're making $20 an hour for a 40-hour week. That's about $800 a week. So within the first month alone, they're going over that threshold. So you definitely want to check in with clients, even if they're only hiring temporary or part-time help.
All right, thanks, Mike. Our next question, what about employees who do not have a social security number or who need to update their ITINs?
Sure. So an employee who has an individual taxpayer identification number or the ITIN and not a social security number, it can get you in a little bit of hot water there. So the ITIN, it's for tax processing. It's issued by the IRS for someone who is required to have a U.S. Taxpayer identification number, but they don't have or are not eligible to obtain a social security number. Those ITINs, they don't serve any purpose other than federal tax reporting. So let's say a non-resident alien who's a college student or a researcher, they might receive taxable payments such as fellowships, scholarships, and awards. They need to report those to the IRS even though they can't obtain a social. The I-10, it doesn't authorize work in the US. It just provides, or I'm sorry, it doesn't authorize work in the US, prove legal immigration status, or the legal presence in a country. In January, when filing the W 2, the Social Security Administration You might get notices and fines if you file a W-2 for an employee that doesn't have a social security number. So if the employee is authorized to work in the US, they should obtain the social security number as soon as possible. And they can even apply for this one online now and use that social security number on all tax documents going forward.
All right, Mike, just want to mention that if any of our attendees today has a question, they should probably submit it now. If you'd like to get it answered, or Mike's contact information is right there on the screen. If you have a question later on, you can contact Mike, but we just have a few moments left with you, so we'll get to a couple of more questions here. How do you structure payroll and taxes for a live-in nanny or nanny shares?
Yeah, so we'll start with the live-in nannies first. We've touched on overtime and sleep time for live-ins. Many of the same domestic worker protections we've discussed will apply to those live-in nannies. A family can exclude the cost of the room and board for their nannies or from their nanny's pay, as long as the meals and the housing are provided in the family's home for the family's convenience. However, the nanny's rate of pay after those deductions must still be at or above the prevailing minimum wage. A family can also be deemed a landlord if they take room and board out of their employees' wages, because now the nanny is considered to be paying rent. So the family in this case will need a landlord tenant agreement along with a nanny contract. In certain states like Massachusetts, you're not allowed to deduct the cost of housing from your nanny's pay if the job requires them to live in the house. As for the nanny shares, each family in a nanny share is considered to be a separate employer. So each family will need to have separate tax IDs, separate workers' comp policies. Pretty much anything that would go into the household employment needs to be duplicated across both families. And then both of those families will need to pay at or above the minimum wage.
All right, thanks, Mike. We probably have time for one more question here. Can a parent taxpayer take a medical expense deduction for payments to an adult child who cares for the parent in his or her home?
So the short answer to this is yes. A parent taxpayer, they are able to take a medical expense deduction for any payments made to an adult child for caregiving expenses, as long as certain conditions are met on this. So the payments, they'll need to be for qualifying medical expenses that are under IRS rules. This will generally include services for daily living activities, so bathing, dressing, and feeding, medication management, or nursing care as well. But general household chores or companionship services don't qualify for this. Medical expenses are deductible only if the parent itemizes the deductions on Schedule A, which is Form 1040, instead of taking the standard deduction. And then that deduction is available for unreimbursed medical expenses that exceed 7.5% of the adjusted gross income. The adult child in this case must report the income on their tax return. A formal caregiver agreement should also be in place to help establish that payments were legitimate expenses and not gifts. However, if the adult child is providing caregiving as an employee, then the parent could be considered a household employer and should be withholding taxes and giving a W-2, along with the other responsibilities we've discussed. So you can do it one way or the other, either be the household employer or do medical expense deductions. The household employer approach, it may be best if the caregiving relationship is more structured and ongoing and involves significant non-medical tasks. It should be used if the child does not provide services to other clients and really just works for the parent. The medical expense deduction approach, that's going to be more ideal if the child provides services that strictly qualify as medical expenses.
All right, thanks, Mike. That's all the time we have. If we didn't get to your questions, we'll be sure to follow up with you by email or phone. You'll also receive a PDF copy of this presentation by email later today. You're eligible for CPE credit if you participated in at least 3 of our poll questions, and you'll receive that certificate of completion by email within the next 5 business days. Again, if we can be of any assistance to you or your clients, please don't hesitate to reach out. We'll be happy to help. And once again, thanks again for joining us today. Have a great rest of the day.